Hello everyone, this is Lindsay Kline, host of the By the Books podcast and founder of Great Bookkeepers Wanted, empowering bookkeepers and the businesses that need them. I'm going to do something fun today. I am going to attempt to demystify accounting principles, at least some basic accounting principles. I know how confusing accounting can be. I remember as a young accountant trying desperately to understand why a bank account would be debited to increase the account. That made no sense to me. So I get it. Debits and credits were so confusing to me, I did not understand. So I hope I can help here. I have this nifty little scale and some colorful cubes to help. So in accounting, there's two things that have to balance. One of them I just mentioned, debits and credits. Debits and credits always have to match. They always have to be equal. But whoever decided to call it debits and credits, can I have a word with you? Why? It's so confusing. Accounting is already confusing. Why do you gotta make it worse for us? Because in the English language, we associate debits with decrease and credits with increase, except in accounting. Sometimes it's that way, but sometimes it's not. Sometimes it's the opposite of that. Talk about confusing. So if you're just getting started learning these principles, it might help to associate debits and credits with something completely different, something unrelated, peanut butter and jelly, polka dots and stripes, left and right. I'm going to use left for debits, right for credits. And the reason I'm doing that is because in most accounting software that I've seen, the debit column was first on the left, credit column was second on the right. So I'm going to stick with that same principle. But whatever works for you. Pick something completely unrelated that you don't link automatically to decrease and increase, because it's not always that way in accounting, and you'll get so confused if you think of it that way. The second thing that always has to balance is what is known as the accounting equation. And that's what I'm going to use the cubes for. I picked these colors for a reason, and I'll explain that in a second. The accounting equation is this: assets equal the sum of liabilities plus equity. So assets is green. That's our assets right there. Liabilities are blue, equity is yellow. The reason I picked blue and yellow and green is because if you mix yellow and blue, you get green. And I thought that was a good visual representation of how you reach the accounting equation. You've got to mix these two together and total them, and it should be the same as the total of this. All right. Accounting equation. Where do we find these accounts, by the way? You would find these on the balance sheet. If you open your client's balance sheet, you're going to see assets at the top, followed by liabilities in the middle, and then equity will be at the bottom of the balance sheet. If you work with a client that has no liabilities, they don't do anything in debt, they don't have credit cards, they have nothing at all that could be considered a liability, you may not see this middle section. But regardless of what the totals is, this should total the sum of these two. Okay, let's follow Sally, who is starting a lemonade stand. We are going to be her bookkeepers and help her record all of her business transactions. Sally is only 8 years old and she doesn't have any money yet. So her parents decide to help her get started and give her a loan. So let's record that first transaction. Sally received cash and she got a loan. Well, cash is an asset. So I'm going to take one of the green cubes, and we are increasing cash, which is a debit. I know, confusing. I'm putting it on the left to represent debit. So we're now out of balance, as you can see. We need something on the credit side, on the right side. That's going to be the liability, the loan from her parents. Now, we're equal again. We balance. Debits equal credits. All right, well now Sally needs to go and purchase her ingredients. So she goes to the store, she hands cash to the cashier, and she gets lemons and sugar and everything she needs. Okay, well we're dealing with cash again, but this time the cash is being spent, not received. So this time it goes on the right side. That's a credit. Because that makes sense, right? Well, what's the other side of that? It's an expense. The lemons, the sugar, all of that. Specifically, this is going to be cost of goods sold expense. Now, I'm going to make a side note here. If you're dealing with a larger client, this will not go into cost of goods sold expense. It's actually going to go into inventory asset. It's an asset account. But if you're not dealing with a larger client that doesn't need to track inventory, you can just say, la, 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 don't need to know this yet, and that's fine. In fact, a lot of bookkeepers don't even deal with inventory clients. So if you're not dealing with a client with inventory, you don't need to worry about this. Okay, I did want to make a note that it doesn't always go straight to cost of goods sold expense. That really only applies to smaller businesses. All right. Expense, cost of goods sold expense. Which of these three colors would I put on the debit side to represent that cost of goods sold expense? This may be a harder question than you realize, because as bookkeepers, we're used to seeing income and expense accounts on the income statement, but there's no income and expense accounts that are balance sheet accounts. Well, here's something really important to know. Every business transaction from the beginning of time is included on the balance sheet, including income and expense accounts. In fact, the income statement that has the income and expense accounts is actually just a detailed report of one of the line items on the balance sheet. You know how in a lot of accounting softwares you can click on a number on a report and it will pull up a new report that has the detail of everything that's included in that total that you clicked on. Think of the income statement like that. It's a detailed report of retained earnings. Now, there could be some other things in retained earnings besides what's on the income statement. But in a lot of cases, if you open that income statement, it matches exactly to retained earnings. So, where would that be? Does anyone know where retained earnings would be on the balance sheet? Which of these colors? That actually is an equity account, yellow. Now, I want to make another side note for QuickBooks users, because QuickBooks does retained earnings a little bit differently than a lot of other software. QuickBooks actually separates year-to-date retained earnings from the rest of retained earnings. Retained earnings has all income and expenses from the beginning of time, but QuickBooks will separate year-to-date. So there's going to be two line items that you have to total to get the true retained earnings. The line item that QuickBooks shows as retained earnings is actually everything prior to the current year. There will be another line item in the equity section of the balance sheet that says net income. That is year-to-date retained earnings. So I just wanted to make that note so I don't confuse QuickBooks users. Regardless though, it will go in equity. We are increasing a expense account or debiting an expense account which also is an equity account. So that's going there, and now we equal again. All right, so we've got our ingredients. Now the customers come. We're making sales. Customers are handing Sally cash, and they're getting their delicious lemonade. So let's record those transactions for her. Cash, we already know, that's an asset, that's green. But this time she's receiving cash. Her cash is going up. So, true to form, we gotta make it confusing. That's a debit. We debit cash to increase cash. What's the credit side? Well, that's sales, revenue. That's an income account. And as we just discussed, income and expenses all fall under retained earnings, aka equity. That's going there. So now we're in balance again. Well, then Sally has a friend that says, Sally, this looks so delicious, but I don't have any cash. I have to go get some cash from my mom. Can I have the lemonade now and pay you later? Sure, friend. So he takes off with the lemonade and an IOU. All right, so as her bookkeepers, how do we book this? We don't have cash, but there's another asset involved here. That is accounts receivable. It's still an asset. It's a receivable note, essentially, called accounts receivable. We're increasing the asset, which is a debit. That goes on the left side. What about our credit side of the transaction? It's still a sale. So it's still going to be revenue. It's still income. And that is an equity account. So that is what we're going to put on the credit side. So we're in balance again. Well, then her friend comes back and comes to pay her the cash that he got from his mother. So cash goes up. That's our asset. And when cash goes up, it's a debit. What is our credit side of that transaction? It's accounts receivable, because he's paying down his note, he's paying down his balance. So accounts receivable is going down, which is a credit. But here's a situation we haven't had yet. That's also an asset. So I put an asset on this side for cash. Now I'm about to put an asset on this side for accounts receivable. But it still ties. Our accounting equation is not out of balance because one side is a debit and one side is a credit. So the net difference is 0. All right, so now that she's got some cash, she decides to pay mom and dad back. So cash is exchanged. She gives her parents back their cash, and her loan goes down to 0. So cash, our asset, goes down. That's a credit. Loan, which is liability, also goes down, which is a debit. Now we tie again. Last but not least, Sally finally decides it's time to pay herself. So she gives herself some cash. Well, as we already know, cash is an asset. The business is paying out the cash to Sally. So if cash is being decreased, it's a credit, of course. I mean, who wouldn't know that? And then what's the flip side of that transaction? We've got to figure out what's the debit. Owner is paying herself. Well, that falls under equity. Anytime there's a distribution, dividends, withdrawals, whatever methodology is used to give money to owners or shareholders, that flows through equity, which is yellow. That's our debit side. And look at that. We're equal again. Our debits equal our credits. So we tie there, but do our assets equal the sum of liabilities and equity? Let's find out. We're looking for the net difference, right? Because one side increases everything, one side is going to decrease everything. So what we're looking for is the net difference of every color. So let's pull out each side and see what we have here. Green is our assets. Yellow is our equity. Blue is our liabilities. Okay, so on the debit side, I have 4 assets. On the credit side, I have 4 assets. Those tie. 0 net balance, 0. All right, what about equity? On the debit side, I have 2. On the credit side, I have 2. Difference is 0. What about liabilities? I have 1 on this side, 1 on this side. Difference, 0. Now, it may not always work out that way. If I had done another transaction, it probably wouldn't have worked out that way. It could have been a net of 1 or 2. It doesn't always have to be 0, but the difference is it needs to match, right? If there's 2 equity and 1 net liability, it needs to match 3 assets. Hopefully that makes sense. So the difference doesn't always have to be 0. It just happened to work out that way. The net could have been, and just to demonstrate, you might have had 4 liabilities on this side and 5 on this side. So the net would have been 1 different. Hopefully that makes sense, that it's not always going to be 0, and it doesn't have to be. We're just looking to know that assets equal whatever the amount is that is the sum of liabilities and equity. And that could be 0, it could be 1, it could be 5 million. Whatever that number is, those things need to tie, as well as our debits and credits. Hopefully that makes sense to everyone. I am always happy to help. Any questions you have, feel free. Message me on LinkedIn, send me an email, send me a message on Facebook. I am always happy to help. Until next time, Lindsay Kline, founder of Great Bookkeepers Wanted, empowering bookkeepers and the businesses that need them.